Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Charlie Pellet. Doug Krisner's off this week. Asian stocks opening higher following a new record for the S&P 500 index on Thursday. Market watchers will be shifting their focus to the August U.S. jobs report due at 8:30 a.m. Wall Street time. Coming up, we'll get the views of David Chao, global market strategist for the APAC at Invesco. Meantime, President Trump has signed an executive order formalizing a long-awaited trade deal with Japan. The agreement caps tariffs on most Japanese goods, including cars and auto parts, at 15%. And it comes after Japan's top trade negotiator, Ryosei Akazawa, reportedly met with President Trump in Washington. For more, we heard from Bloomberg News Desk Editor Balazs Penz, who spoke with Bloomberg's Paul Allen and Avril Hong on the Asia trade.
So, Balazs, looking at this EO, markets are cheering it on. What do we know about how the trade agreement is going to be implemented?
Yes, good morning, Avril. Japan has been a bit of a model student when it came to these trade negotiations. They were one of the first countries to strike a deal. They got one of the most favorable tariff rates, and they were the country that pioneered this whole framework where the deals include a large investment agreement. So what this does now is it solidifies the implementation of that deal, which is something that Japan has been pushing for ever since that initial agreement came together back in July. And crucially, it prevents the stacking of those tariffs. If you remember back a few months ago, there was a little bit of sort of parallel talk between the U.S. and Japan about whether those tariffs might be stacked or might not be stacked. They won't be stacked. So that's a huge relief for especially the Japanese automotive industry. So we now know that the implementation can start in a few days and that it will apply to those very, very crucial companies. Some questions still remain, especially around that investment pledge, but this is certainly good news for Japanese equities.
Well, Japan's top trade negotiator, Ryosei Akazawa, is in the U.S. at the moment as well. Is there still some work to be done here? Is there potential for further announcements?
Yes, Akazawa had some very high-profile meetings. He met with Secretary Lutnick. He met with President Trump yesterday, and it does seem like his presence in D.C. helped push along this agreement. But the big question is how that $550 billion investment pledge is going to work. There was a lot of disagreement between the two sides about what that might entail. There seems to be a lot of questions about what form that investment might take, who will be in charge of it, what will happen with the proceeds. So there's some work still to be done, but certainly Japan is ahead of a lot of other countries when it comes to their trade agreement.
We're also hearing how Akazawa says these tariffs damage Japan's domestic industries. What would you say, can we count this as a sort of good outcome already for Japan at the moment?
Well, define good, right? Tariffs are not a great thing for any exporting country like Japan is, and certainly whenever you have to contend with those tariffs, those higher input costs, that makes it more difficult for them to compete on a very important market like the U.S. On the other hand, we do see that Japan was able to achieve a lot more favorable terms than a lot of other countries, a lot of their competitors, especially thinking about countries like India, like Brazil, like South Africa. There are a lot of countries around the world which have to contend with much higher tariffs. So it might be a bit of a win, but certainly whenever there are tariffs imposed on a large exporting nation, that will be difficult for the economy.
All right, Bloomberg News Desk Editor Balazs Penz there.
Welcome back to the Daybreak Asia podcast. I'm Charlie Pellet, in for Doug Krisner this morning. Treasuries rallied across the curve in the Thursday session on Wall Street. The policy-sensitive U.S. two-year yield fell 3 basis points to the lowest in around a year Thursday. Money markets almost fully priced in a Fed reduction this month and see at least 2 by year-end. Friday's U.S. jobs report is expected to extend the weakest stretch of job growth since the COVID pandemic. And for more, we heard from David Chao, Global Market Strategist for the APAC at Invesco. He spoke with Bloomberg's Paul Allen and Avril Hong on the Asia trade.
Good to see you, David. So we're seeing maybe some incremental positive news on Japan. How much of that do you think is already priced in by markets?
Well, I think that we continue to be in an environment where there are lots of developments for trade, for geopolitics. If you look at some of the trade tariff-related indexes, the uncertainty level still remains high. So I think that even if we have some positive developments here with Japan, it could very much be punctuated in a few days with some perhaps negative developments for tariffs. Remember, we still haven't had the sector-related tariffs to things like pharmaceuticals, semiconductors, that are likely to come down the pike. So when all is said and done, there still is a bit of uncertainty when it comes to trade and tariff developments. But I think Japanese markets, there's still some upwards trajectory. We really like the Japanese yen. We think that maybe a rate hike could come sooner rather than later. And this is certainly going to be a boost for the Japanese yen. We think it'll be the best performing currency in the next 12 months.
You talk about the uncertainty. We did get Trump, though, signing the executive order to implement that trade agreement with Japan. We're hearing from the trade negotiator in Japan himself saying that they welcome this executive order as a firm implementation of the deal. Also seeing in market reaction, Toyota shares rising about 3% after Trump signed this order on the tariff deal. How do you position, as you say, amid this uncertainty?
Well, I think that Asian economies have done much better when it comes to tariff negotiations with the U.S., especially Northeast Asian countries compared to, say, Southeast Asian countries. Now, overall, the APAC region, I think the risks related to tariffs so far have been more mitigated than originally anticipated in the April kind of Liberation Day. So I like the APAC market more than other places like Europe or the U.S. I think growth is starting to firm up a bit. PMIs from China to other parts in Asia have started to turn up. That's a positive leading indicator. Asian central banks are likely to cut rates more and more quickly than the Fed. And so I think that there are more positive catalysts for Asian markets for the remainder of the year.
I do want to get your view on the Fed as well, because we've got the S&P at a record on expectations that we're going to see some easing this month. But are you at all concerned about these questions around Fed independence? The market's not really reacting to that at the moment. What are your thoughts?
That's right. I agree that we're going to get a cut in September from the Fed. And I also think that markets are underpricing the risk of the Fed independence or the lack thereof. And it is quite worrying, I think, especially since the Fed has been an independent institution being able to think and govern and weigh growth and inflation risks. And so I think that investors should be watching this very closely. We have a court case going through right now with Fed official Lisa Cook. And so I will be watching very closely and how that plays out.
You were mentioning you're quite upbeat on Asia-Pacific stocks, Japan as well particularly. But how about China? Because we've seen some very strong buying of Chinese equities and indeed record borrowing to fuel some of these purchases to the point that regulators are now considering curbs. How sustainable does the rally in China look to you?
Well, I think that the momentum that we've recently seen in China has very much been driven by domestic buyers. We haven't really seen foreign capital flow back into China. And there's certainly lots of interest. Many of the clients that we speak to in Europe and South America and even in the U.S. are starting to look at Chinese equities and Chinese markets. The liquidity that we've seen boost Chinese equities has really been through monetary easing easing and cuts to interest rates in China over the past 6 months, and that's starting to take a greater effect. Also, lower interest rates in China have also bolstered Chinese retail investors to look at higher yielding investments, and we're seeing that flow into Chinese markets. But overall, I think that the momentum can be sustained because Chinese equity valuations, while they're above perhaps historical levels, I don't think that they're trading at any kind of worrying or expensive valuation levels.
What about valuations for the U.S.? I mean, you touched on some of this earlier. Given how concentrated it all is in tech, how much of a risk is there that we see a pullback?
Well, September has historically been the worst month for U.S. stocks because of trading illiquidity and also lack of catalysts. So I do want to caution investors as we head into the rest of this month that there could be market volatility more than usual. And if that happens, I think it could be a buying opportunity, especially if the sell-off is unexpected. But in general, I like to be a little more defensively positioned now for U.S. stocks. Defensive stocks are trading at a much more palatable valuation level. Healthcare, utilities, consumer staple stocks. These are more attractive than I think the growth in tech stocks that have really surged recently.
I wonder if you could weigh in also on what's expected from the jobs report, because we have seen recently that among the sectors that have supported the labor market, the acyclical parts, that seems to potentially be cooling off or easing off a little. Is that a concern for you when you look at the broader picture in the U.S.? I
am concerned about the labor market in the U.S. It seems like we've had a slowdown, a cool down over the past few months. And even for the entire year, the revised estimates for the jobs number has always been lower than what was reported. And so as we look at the upcoming jobs report, I don't think that it will surpass expectations. And that's why I think that the Fed is likely to lower rates because the labor market is starting to show cracks.
All right, David, thanks for coming in. Nice to see you. David Chao, Global Market Strategist at Invesco.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.